How does AML apply to cryptocurrency exchanges? Have you ever wondered how anti-money laundering regulations apply to cryptocurrency exchanges? It's a fascinating topic that touches on the safety and security of digital currencies. Let's break it down. Anti-money laundering regulations are designed to prevent money laundering and other illegal financial activities. Cryptocurrency exchanges, whether centralized or decentralized, must follow these rules to maintain a secure environment. Centralized exchanges operate much like traditional banks. They have to implement strict compliance programs. One key aspect is Know Your Customer procedures. This means they need to verify the identity of their users. They collect government-issued identification, proof of address, and sometimes even biometric data. This helps ensure that users are who they say they are. Another important measure is customer due diligence. This involves assessing the risk level of each user based on their transaction volume, trading behavior, and geographic location. Users deemed high risk may undergo enhanced due diligence, which means they are monitored more closely. Centralized exchanges also utilize continuous transaction monitoring. Automated systems are in place to flag any suspicious activities in real time. This is crucial for identifying potential illegal actions before they escalate. Additionally, these exchanges must comply with the travel rule. This rule requires sharing certain customer information between financial institutions when transactions exceed a specific amount, like $1,000. This helps trace funds moving between exchanges or wallet providers. Record keeping is another vital part of AML compliance. Centralized exchanges must maintain customer data and transaction logs for several years. This is essential for regulatory audits and investigations. They also need to report any suspicious activities to the relevant authorities and conduct periodic internal audits. Now, let's talk about decentralized exchanges. These platforms operate without a central authority. This makes it more challenging to enforce AML regulations. Users transact directly through smart contracts, which means there is no central entity to perform identity checks or monitor transactions. The peer-to-peer nature of decentralized exchanges complicates the verification of user identities and sharing of customer information. However, some decentralized exchanges are looking into ways to incorporate AML compliance. They might add optional identity verification layers or collaborate with regulated entities to help meet these requirements. When it comes to fees and order types, AML compliance can impact operational costs and user experience on centralized exchanges. Implementing Know Your Customer and transaction monitoring systems requires investment. This may be reflected in trading fees. Centralized exchanges typically offer various order types, such as market orders, limit orders, and stop orders. With AML compliance, these orders are placed by verified and monitored users, which helps reduce the risk of fraud. In summary, anti-money laundering regulations apply to cryptocurrency exchanges by imposing identification, monitoring, reporting, and record-keeping obligations primarily on centralized exchanges. Decentralized exchanges face greater challenges due to their design but may adopt hybrid solutions. These regulations affect how exchanges operate, their fee structures, and the security of order execution processes.